Welcome to this conversation, a conversation which truly excites me. I like discussions around capital raising. And I want to start with Mr. Kiprono Kitoni, who was not with us yesterday. Yesterday, we had a conversation around mobilizing capital for financing of sustainable energy solutions, and largely from the private market side. So now that you're here as the chairperson of the Nairobi Securities Exchange, I want us to talk about the public markets. So what opportunities exist for mobilizing capital when it comes to public markets? Mr. Kiprono.
Thank you very much. First of all, I'd like to take this early opportunity to laud Kengen and the Nation Media Group for this conference, discussing issues and topics that really are in sync with what is going on globally. I think Kenya is a signatory of the Paris Accord, and hence we are committed to a more sustainable future. At the NSC, we are making it an imperative, and indeed it will soon be in the compliance requirements, that all listed companies should be preparing annually ESG reports. ESG standing for environment, sustainability, and governance. And there is empirical evidence globally that better governed companies that are committed to sustainability are actually better platforms for a resilient creation of wealth. So, there is plenty of funds. A lot of people say there is no money. But on the contrary, there is too much money chasing the right sustainable business models. The Global Climate Fund is awash with money. Investors globally today, sophisticated investors, are looking for opportunities to finance enterprise that is committed to a sustainable future. BlackRock, which is the largest investing group on earth, has committed by the year 2030 that 75% of all their investments globally, and they are the largest investors globally, will be those in enterprises that are committed to zero emissions by the year 2050. Jeff Bezos, I think we all know Jeff Bezos, is the third or fourth wealthiest man on earth. He's committed $2 billion for conservation of the environment, and $10 billion additional dollars for enterprise that goes into sustainable zero emission. And in fact, Amazon has said by 2025, they themselves will be on zero emission. So I just want to say that the timing is right for these conversations. We need to be looking at renewables. We need to look at how we will deal with this existential crisis, because the global warming is an existential crisis. And in Kenya, we are leading the charge. The NSC is the first exchange in Africa to list a green bond. Last year, we cross-listed with London Exchange, a green bond for Aecon, and they were able to raise about 4 billion shillings on their first round on that bond. So the other thing that I'd like to say is the liquidity in the market far exceeds the places where it can be placed. Global funds, local pension funds, local high net worth individuals, local retail investors have far more money than the available products. So that is why oftentimes you hear me talk about the need for more listings, the need for more products, and the need for more outlets for that cash that is chasing opportunities. Thank you.
Thank you, Mr. Kitoni. Let me cross over to Janice. And what Kiprono is telling us is that the markets are awash with liquidity. The problem is the viability of a pipeline of products. Is that an assessment you share?
Absolutely. I think I can't agree with Kiprono more. There is a lot of capital, particularly for sustainable and green projects. In addition to the Jeff Bezos and the BlackRocks, you've got the Global Financial Alliance for net zero. I think they've committed about $130 trillion towards green and sustainable. And if you look at some of the reports that have been put together by people like the Climate Policy Initiative, you're so disheartened to see only about 3% of the global climate finance capital flows end up in Africa. So we're clearly not positioning ourselves because we can't say that there aren't the projects and there isn't the need. What we need more of is more project preparation facilities. We need more incubators to support local developers to put together projects. And I just think we need more technical assistance to help projects become bankable. Because the issue you always find as a financier, you really want to support a project, but there's so much homework to be done. And that, I think, is what's missing in the market at the moment.
I like there's so much homework to be done when it comes to the due diligence side of it. It's quite some work. Let me come to George Njenga. And George Njenga, you sit on the other side. By that, I mean the private side. Just begin by walking us through your philosophy of investment, especially within the context of sustainable energy.
Thank you, Julian. First, I think I start with great recognition to KenGen and Nation Media Group for hosting this event. And I look at the subject of sustainable energy, and you think about what we call the energy maturity continuum. I think countries in Africa deal with access, affordability, reliability, and the very advanced ones are talking about sustainability. So really being here, talking about sustainability, just shows how far our country, the market has come in terms of maturity. Maybe I can say a bit about AP Moller and then talk about the investment philosophy and being on the other side. So AP Moller Capital was started in 2017 as a fund manager for institutional investors, mainly AP Moller Holding as an anchor investor and a number of pension funds. So they put up $1 billion of infrastructure targeted funding for Africa. And so far, these funds have been targeted to 9 countries where there are a number of infrastructure projects, mainly in power and energy, as well as transport infrastructure. In Kenya, we have so far deployed $200 million from that fund. So you can see 20% of the fund is in Kenya. We have now commitment to do another $200 million. And these have been targeted at a number of energy assets that are already owned, starting in 2020, April, when we acquired a power plant, Iber Africa Power. And then recently, as early as March, Thika Power, as well as Clean Energy Distribution Company. Now, you talked about the philosophy of how maybe private investors, and specifically AP Moller Capital, targets its funding. So we're kind of influenced by 3 key themes, and we call them sustainability themes. Number one is just looking at global mega trends. Among them today, you can talk about global trade, you can talk about energy transition, but we also are influenced a lot by not just returns. We are influenced by what social positive impact our funding and participation in projects contributes. A key theme of investment underlining that principle is doing well while doing good. The third theme that influences our investment philosophy is not just participating as equity or owners, but as active owners, where we can literally influence how those investments behave over time. So in that regard, and talking sustainability, often I'm asked, you've invested in 2 thermal assets when the world is saying no, not to thermal, go to something else. And I tell you what I'll share, I'm sure is something I share with Rebecca and the Kenyan team, because they also have some thermal assets. You have to look at energy in a transitional kind of framework. You have assets that you need to green today, right? Because that's what is generating power today, as we aspire to go to what we need tomorrow, which is pure green if we can. So the investments we have, we are busy greening them, starting with the internal efficiencies. You'll be surprised that in just less than 1.5 years, we've displaced about 100 tons of diesel per annum that was going to just internal consumption of the plant to keep them warm, to keep them ready to start. And all of them have been replaced with solar, not just solar panels, but solar concentrators that are able to drive temperatures up to 160 degrees C. So all our auxiliary heating, to a fair extent, is all renewable today. And with that, we are saving more than 800 tons of CO2 per annum. So that is one. The next one is you are still producing CO2. So why are you producing CO2 when you should be going sustainable? We are busy with KFS, Kenya Forest Service, and KEFRI. We've signed a partnership. We are busy in Cheptais in Mount Elgon today, planting a lot of trees. So 560 hectares. And we also engaging with government and MOE specifically to say, how can we make this even bigger? Because what we emit today, we need to get it out of the environment while the maturity of batteries and so on comes to space.
George, let me respectfully hold you there and maybe just ask a quick rider to the point that you raised. So you raised $1 billion of a war chest. What's your typical ticket size when you're deploying to a project?
So look, I don't think we have real restriction on ticket size. So in Kenya, we've had a range from $40 million to $100 million of individual transaction, and that is equity investment. And then we can leverage that with debt and make much bigger participation.
Okay. Thank you. Very strong introductory thoughts there. Let me come to Fred. And Fred, the first three speakers are basically on the supply side of capital. I think you're on the demand side. Tell us what you're doing, especially within the rural setting, as far as projects, sustainable energy projects are concerned.
Yeah, first of all, I think I would like to thank the National Media Group together with Kengen for convening this very important workshop. Two is I would want just to mention that I work with the Rural Electrification and Renewable Energy Corporation. This is a fully government-owned parastatal organization that has a mandate to promote and implement projects, especially in those areas. Many words have been used, but I can say that are hard to reach in terms of the cost of reaching them through grid extension. And as a corporation, we are very much to those areas that are underserved, ensuring that these communities are able to access clean energy, both electricity, which has been the main focus, and also clean energy in terms of cooking. Yeah, but when now we look at the whole dynamics of funding, traditionally we've had a government footing in much of the cost to be able to elevate those communities that are underserved. And we have done this through various methods, mostly looking at setting up decentralized power generation systems. These are mini grids. We, as a corporation, have been doing quite a number of activities also related to extension of grid to those also local communities, and targeting specific public institutions and therefore distributing to the local nearby communities. But in terms of the numbers, over 20,000 schools since the program started as REA in 2004, when we had way below 10% of the country connected. And right now, you can see the great number that we are talking about, just a percent or two shy of 80% connection. Yeah, so these steps, as I can say, in addition to what the government has been doing to primarily take charge of supporting through the funds we collect, we are also having development partners very important in this, because in a bigger sense, these areas are mostly commercially unviable, and therefore extending, apart from the subsidies and kind of playing gap of the deficit that can be done, then we depend more of also grants from outside. Like when we talk of the COSA project, we talk of the Kenya Electricity Modernization Project, where we get funds from development organizations like World Bank and the rest. Yeah.
All right, thank you for your introductory thoughts. And when I come back, I'll be seeking to understand how you're going about diversification of your funding sources. But before that, let me come to Mr. Kiprono Kitoni here. Now, George did indicate to us that he mobilized $1 billion, largely from pension funds. When you look at the pension funds in the local scene, according to the latest data from the RBA, 1.4 trillion worth of assets under management, the bulk of them in fixed income. Do you think there's a point where we'll begin to change this asset mix to move more towards infrastructure projects like what Kenjan is doing here?
I think most pension funds, I cannot speak for the pension fund industry, but I think most pension funds are more concerned about long-term sustainability and just ensuring that it's a safety net for pensioners. I would say that at the moment the instruments that we have in the market are insufficient to meet the liquidity that most of these pension funds have. And for that reason, in fact, this speaks to the broader conversation of the development of Kenya's capital markets. That is the reason why we need to see a more sophisticated market with more listings of companies. I can see in the room, the chairman of Toyota. We want to see most of these companies come onto the market. We'd like them to list their shares so that the pension funds have more avenues to deploy their capital. But at the moment, we are seeing the liquidity that is available in the market being distributed mainly, or rather being deployed mainly to sovereign fixed income bonds. And that presents a challenge in itself, because what happens, that tends to wipe out the liquidity in the market, because most liquid funds will be actually deployed to these high interest earning instruments instead of actually going into enterprise development. So I would just say that we need to develop our capital markets more. We need to have more products, more green products that are climate friendly, that mitigate climate effects, and that are also providing an avenue for long-term sustainability. And we'd also like to see more listed companies. I mean, in the bond market, we've seen huge oversubscription. For example, the recent Kenya mortgage refinance bond was 400% oversubscribed. So that actually speaks to an oversupply of liquidity. And back to the question of people in Kenya liking to say that they are broke. It is true that they are broke, because the issue is the distribution of the liquid resources in this market.
Kiprono here is intimating that we have a scarcity of products, structuring of products, which would be able to ensure that we tap into some of this capital to go into sustainable energy projects, for instance. Is that your assessment, and what do you think we can do about this?
I think, okay, I agree and I disagree to a certain extent. I think that, you're right, there's a lot of liquidity, and pension funds are willing to invest in liquid assets, and if they're listed, it makes it a lot easier. But even then, pension funds have to think about people's retirement money. And so by their very nature, they're risk averse, which means that they will only invest if there is some sort of de-risking instrument. And that's essentially what we saw with Acorn. That unless you got a rating that was as good as government or better, then you're not going to be able to mobilize that 1.4 trillion into infrastructure. We have seen progress. I think this year there was another, I think it was private, not public though, instrument, again in infrastructure for a road project. It was 100% guaranteed, and there was 2.5 times oversubscription for the instrument. So I guess I'm saying it's not just as simple as listing. We also need to think about how we structure and de-risk these projects to make sure that pension funds are in a position to be able to invest in them. Because you're right, pension funds are holding that long-term local currency liquidity, which would be ideal for local infrastructure projects. And that's something that needs to happen with time, particularly if we have more sustainable green projects. What I was going to also say, though, what I agree with, though, is that there aren't that many projects yet. Yes. And that goes back to the point I was trying to stress, that the successful projects, again, riding on the Acorn example because it's quite public, there was technical assistance involved in that, in both getting the green rating, in paying for the rating agencies, which was Moody's at the time. And I think, for energy projects, given the sort of development that energy projects have to go through, getting permits and licensing and working out the technologies, incubators also play a very important part. And there's some exciting developments in that regard. So Serengeti Energy is one of the Pan-African energy developers. They're launching an incubator called Umoja to support local developers develop projects, because it's a genuine issue. You've got these teams in private equity firms looking for projects to fund.
Okay, so here we have Kiprono and Janice telling us the pension side is quite risk averse, but there we have George, who is actually taking equity stakes in this kind of projects, infrastructure projects around sustainable energy. George, is it that your risk appetite is high, or how do you do your funding structuring?
No, thanks. I think that's a good question. I think it's all about how you maybe appreciate the sector. And in energy, for example, this is very fundamental to everything else you do. So at a philosophical level is that energy demand will continue to grow. In between, there'll be headwinds. And I'll give you maybe a very topical example. So recently, last year, we went through this moratorium on any new PPAs, right? So if you talk to developers that we're talking about, developers took it in different ways. Many of them still looking at it as, is this a safe environment to put money, because the regulatory framework might change without notice, and instruments like government letters of support and so on potentially get taken away. And we had very robust engagement with the presidential PPA task force. And I must commend that team, because they were open to listen and to discuss. Those type of headwinds require a bolder view. So that's number one. Number two, I think about education. Just educating would-be investors about the sector. If I give a personal journey, my personal journey in the energy sector is of almost 35 years. Oil and gas, technology in General Electric, and now on the money side. I think I have a fairly decent appreciation of the risks and the opportunities. And the opportunities are immense. Today, I'm listening to the very motivating opening remarks by both Jared and Muli from Kengen and also GDC and KPLC. I ask myself, here where Rebecca is hosting us, we are atop one of the best energy resources. Why haven't we exploited it faster? It is not scarcity of capital. I think it's the whole idea of just understanding the resource called geothermal. Is it risky? Does it deplete? That's purely education. But the other thing is saying, look, between generation, and Carol talked about it with this whole digital conversation, what are the risks in between that lead to losses and therefore make the economics fail? The moment you have an appreciation of that, you will boldly invest. So at AP Moller Capital, our view, for example, is that the thermal assets need with urgency to be converted to gas. And we've done a feasibility study, and we've shared it with the Ministry of Energy with a proposition on actually within a 3-year time frame. If we are bold and if the legal framework is in place, we will invest our own dollars in the ecosystem. So there's appetite to invest, but sometimes I sense that there's also hesitancy of working closely between private sector and government. And the moment we are more transparent through engagements like the ones we have today, and we understand what is the agenda for KenGen, what is the agenda for this private equity, and we understand what those agendas are, how does each get their return, okay? How does it meet their KPIs, be it sustainability KPIs and so on? There is nowhere that capital will not visit. So we are very bullish about this market. We are very bullish about the African continent. If you look at returns, purely returns, and the panel here, some of the members here are much more, I think, competent than me on returns. The returns you get on an infrastructure project in Africa are much superior than elsewhere. But there's always this notion of, but Africa is risky. So what is the risk-adjusted return for Africa? And that's the discussion. And once you have that appreciation, you will invest. And I would encourage, Kenyan pension funds, and we are pitching to them, right? Because there's also the notion of these investments are being made by foreign organizations. No, this investment, we are willing to partner with local pension funds to share with them our experiences from other markets, from Denmark, from Germany, from China, from wherever we play, and say, how can we make it work in Kenya?
Okay. Thank you. And maybe before I let you go off, George, a very quick question to that. So one of the issues which investors will raise with you again is that if I'm to deploy capital in a market like Kenya, I don't want too many fragmented projects. I want a few sizable projects. So to what extent is availability of a pipeline of investable projects a challenge in this?
So I think in terms of pipeline in the energy sector, not just power and energy, today I see a pipeline of almost $1 billion in Kenya alone. So those are sizable investments. So the investment opportunity in geothermal, the investment opportunity in wind power, the investment opportunity in battery storage, and all these we are actively evaluating at the moment. So I don't think there's a shortage of projects per se. There's more of risk appetite challenges than a shortage of projects. We talked about energy access, and Kenya has done extremely well in terms of the 75% and over access. But if you move a bit more regionally than just talking about Kenya, we're still talking about 40% of people in sub-Saharan Africa have access to electricity. What happens to the balance? I think they can do it. If you compare this with the mobile telephony story, the story was that people cannot afford mobile phones because they are poor, right? But today you go to the most rural part of the country, you'll find that show somewhere in Turkana with a smartphone. Why? It's affordable.
Correct.
It's affordable if you make it affordable. And it's affordable if the value of owning a digital phone exceeds the cost of getting it. So is power.
Thank you so much, George, for that. Let me come to Fred. And Fred, we are interested in understanding how you are now diversifying your funding sources, given the sort of intro remarks you had given.
Yeah, of course, when I mentioned that some of these areas that we are serving, these areas are quite a challenge in terms of being able to do the first investment in renewable energy systems that we are presenting unto them. But here is a scenario. Most of these areas, when we connect them the first time, then we experience a very big spike of demand. Yeah, just like actually it becomes an emotional part and a continuous daily drive to their lives. And therefore absence means life almost stops. People get emotional about it. And of course, with that aspect and the gap that we are having in terms of them being able to pay for the cost of electricity at the rate of the others, continuously we continue recouping the finances that we put. And therefore, this also becomes a revenue generating stream. And therefore, we are able to extend this kind of investment to other areas. But more to that, as government also, we are very happy to continue working even with private sectors. Quite a number of lots that we have. Definitely, we will say that the funding is available, but accessing the funds is also another thing. With the gaps that we still have, and we are not able to allocate the funds that are available, then we still are open to invite private sector to invest in such kind of areas.
Thank you so much, Fred. The funding is available. Accessing the funds is a whole different story. Let me come to Kiprono. There's something George touched on I'd like us to talk about for a bit, and that is the regulatory risk. So the finance bill this year provides green bonds will be subject to XYZ. The finance bill next year changes that entirely, especially with regard to green bonds. Mr. Kiprono, do you think this has been a challenge in terms of uptake?
I think with regard to green bonds, there has been an international conversation about what it is that qualifies projects to be green or not. And there are three, I can cite three examples. I mean, in Europe, for example, they use it's called the green taxonomy. That is the benchmark that they use. National Capital Markets Association framework, and the Climate Bonds Initiative framework, and framework for green investment. So those are, I think it's an evolving conversation about what it is that qualifies a project to be green. But speaking more broadly on regulatory environment, I think we have a huge conversation to be held here. And in my previous role as the president of the Chamber of Commerce, I recognize that one of the unintended consequences of devolution is massive overregulation. And perhaps we have such a huge promulgation of legislation and regulation in this country that it is actually a hindrance on commercial enterprise. And for that reason, you can see that the government actually has got such a huge appetite because of its capital projects, and most of the funds in the market are being deployed to these big capital projects. So for me, I think there's also a conversation to be had, especially around energy, because we are here for an energy conference. And energy, in my opinion, comprises of the chain comprises of generation, evacuation, and deployment. So right now, we've seen most of the agencies, both the public and private sector agencies in the energy ecosystem, really upping their game in terms of energy production. And we heard that geothermal is getting to almost 900 megawatts. But the question is, what is the uptake? We know that the government of Kenya had at one point come up with a plan to create an SEZ in Naivasha with a much limited evacuation cost in order for industry to stimulate itself. And I think we must recognize that the world is going through such huge turbulence right now. There's two phenomena that have occurred over the last 3 years that are really turning conventional macroeconomic models on its head. One is the COVID era and the supply chain challenges it has brought globally. I think a few months ago, they said that in the port of Shanghai, it was taking 42 days for a ship to discharge its cargo and reload, which is unprecedented. We know what's happened with the supply chain issue, and that's really led to inflationary prices in the movement of commodities. And who would have imagined that a country like Ukraine, with 40 million people, feeding 500 million, would create a crisis? I was watching last week on television, President Museveni saying, but who needs Ukrainian wheat? We'll eat bananas. But then the reality is that even Kenya is going to be impacted by what's going on in the Ukraine. So I think for me, it's an opportunity for all of us to think innovatively, to think outside the box, to see how we can make our economies more resilient, and actually to see whether we can bridge that gap. And I think, for example, Kenya has a huge potential to be a huge agricultural producer and do value addition, to use these SEZs to get lower cost of evacuation by making the SEZs that have been closer to the production sources vibrant and effective. But I think there's a huge challenge because of overregulation. Enterprise is suffering with over-taxation, burdened by many regulatory issues, both by national and local governments, as well as the multiple other agencies that have been brought in play. Thank you.
Janice, is regulatory overreach or lack thereof a turn-off?
How not to say? I don't know how to answer. The answer is obvious, obviously. It's a rhetorical question. I think the regulatory uncertainty is not good for investors. I mean, it's something, so one of the other hats I wear is I sit on the board of the Nairobi International Financial Center, and this is one of the things that investors are always asking us about. What's going to change next? We didn't see that coming. But on the other hand, I think we also have to take into account where we are and where the world is. We are living in unprecedented times, as Kipon was explaining. With COVID, we all took action. And I think in Kenya, part of that action was some of those changes to legislation, which unfortunately are not helping the cause of increasing the number of issuances for asset-backed securitizations or for green bonds. Having said that, I think as we move into this post-COVID recovery era, the future is bright. I think the recognition that because of our high debt burden, we need to see more PPPs, more private sector participation in infrastructure, that there's an opportunity for private sector to participate, and with that will come the inevitable push and lobbying towards getting those incentives back that were there in the first place.